This conference will now be recorded.
In today's session, we want to talk about the accounting theoretical framework. We know that the purpose of accounting is to prepare for financial statements, the income statement, the statement of retained earnings, the balance sheet, and the statement of cash flows. So those are the four statements. Those statements summarize all the transactions that a company has. You don't see the individual transactions, but you see the summaries in these statements. So all companies from a Walmart to a very small mom and pop are going to prepare these statements to lay out the financial condition of the company for a particular point in time. Now, in preparing these statements, we have to have consistency because we've got to, let's look at who uses these statements. Shareholders and investors and bankers. And what they have to be assured of is that these statements were prepared on an objective and fair basis, and we can use these statements to make decisions as shareholders about whether we want to continue to hold our shares, or as investors, whether we want to buy stock in the company, or as bankers, whether we're going to loan money to the company. Then customers and suppliers also look at your statements to make sure that you're financially able to pay them. A supplier doesn't want to extend you credit to provide you goods if you're not going to be able to pay them. And so therefore they look at your financial statements. Current and prospective employees. A company is going to provide you a major source of health insurance and retirement. And so before you go work for a company, or if you're currently working for a company, you need to be able to review those financial statements to make sure that the company is stable. So we have a range of people who review and look at financial statements and use those statements, and they have to be comparable, of course, across companies. So we then have generally accepted accounting principles. And there are four main groups that prepare those principles. First of all, the Securities and Exchange Commission, the SEC. And they came into being after the Great Depression and took the lead in saying, okay, this is how statements should be prepared. This is what the content should be. The Financial Accounting Standards Board was formed in 1973. And so as corporations expanded, we needed to bring into making generally accepted accounting principles the professionals that perform audits. And so we bring in now the private sector to help with the Securities and Exchange Commission in preparing financial statements. Then we have the Governmental Accounting Standards Boards, which prepare statements for governments, because as governments begin to get into trouble with their financial statements, we needed a set of standards, as they are also investors also. And finally, we have the International Accounting Standards Board, because we have one world now. And so we need common statements worldwide so companies can be compared worldwide. So these four bodies create the financial statements. From these four bodies, there are 15 generally accepted accounting principles that I'm going to review. There are more, but these are the key ones. First of all, the business as a single entity concept. A business is separate from its owners, from its creators, and all activities are to be treated separately from the owners. Your personal affairs do not go into the corporate entity structure. What are our entities? Sole proprietorship. This is the small business run by one individual. Partnership, a small organization run by two or more companies. The big disadvantage of sole proprietorships and partnerships is that you have unlimited liability. If something goes wrong in your business, they can come into your personal assets. And so limited liability companies were created to solve this problem. And so it can be a partnership, a corporation that's small, that doesn't want to get into the major expense of incorporated, but yet the owners have that protection that anything that happens in the business is not going to spill over into their personal asset. Finally, we have the C corporation. And this is a legal entity that operates under state law. It has to have a name. It has to be file articles of incorporation. And there are a lot of rules and regulations that it follows. So it's there, but there are major advantages such as the limited liability plus the ability to raise money. And then the corporation can provide fringe benefits, but there is a double taxation. Corporation pays tax and the shareholders pay tax. Most large businesses are going to choose that C corporation form. Next, the specific currency principle. There has to be a need to express the statements in terms of dollars. We have financial statements. And so for companies operating in the US, they have to use US dollars. And if they're involved with foreign entities or foreign units, they have to use exchange rates so that the dollars are comparable. So we got an operation in France, we have to convert the franc to US dollars when we look at that operation. These specific time period principles. Typically, we look at financial statements over a 1-year time frame. The income statement covers a year, typically a calendar year, and the balance sheet is as of the end of the year. Then we have historical cost principle. We use historical costs in general. We're not going to utilize inflated values based on appreciation because we don't have objective evidence that will come to fruition. The full disclosure principle, very important. If something happens, such as when there was that major oil spill in the Gulf, BP had to disclose in its financial statements that they might have a liability for that. And of course, with the coronavirus, companies will have to explain what's going to be the impact of their financial statements going forward, even though they may be doing historical statements for the 2019 time frame. In that statement, since it's issued in 2020, they have to estimate what impact that virus is going to have on them in their future statements. The recognition principle, income is recognized when earned, not when the cash is collected. And so we have an accrual basis where if the work has been performed, we recognize the income. The going concern concept, very important. Normally, it's assumed that the business will continue to operate indefinitely in the future. But once again, this concept will have to be looked at critically with the coronavirus, and companies will have to be able, and the auditors indicate that this company can go forward. So whereas this was not a normal concept that applied a lot, it will be applying for statements issued, financial statements issued in the 2020 year. The matching principle, we have to match expenses with the revenue earned. And so if we recognize the revenue, we want to recognize expenses. So this is where we get into making adjusting interest. And the reason we do that, if the income is there, we need to match the expenses because eventually we got to pay tax on that income. And so we don't want the income to be there and no tax, and we're taxed on it without the appropriate expenses. The principle of materiality. If we try to adjust for every item, it would take a whole lot of time and effort. So if it's not cost-wise worth it, we only make adjustments for major errors. the principle of conservative accounting. We're going to be conservative as we're working with our accounting numbers. We're not going to exaggerate it. We're not going to be overly enthusiastic and not show the worst position as opposed to the best position. So that way, when people investing, they know both sides of the picture. Yeah, things can go well, but things can also go positively, go negatively. And so we want to be conservative in terms of what we think is going to happen, what are our income prospects. The industry practices constraint. Sometimes there are special rules for certain industries, and all companies in the industry use it, so we do get consistency. But the banking industry has certain types of principles that they work with. The insurance industry, and here in Houston, the energy industry has certain rules that it works with that makes the statements more relevant. Consistency. The statements need to be prepared the same way each year. We must consistently utilize the same rules. And if we change those rules, we have to indicate that in the statements. Objectivity, we need objective evidence of what happened. We can't just rely on what people think. We need evidence. Accrual basis accounting, as we talked about a little bit earlier with realization, reflects the fact that transactions and events that have occurred need to be recorded in the period that they incur, not when the revenue is paid, or not when the revenue is received or expenses are paid. So with the accrual basis, income and expenses are recorded as they occur, regardless of when the cash changes hands. On the other hand, that final statement of cash flow, looks at the assessment of cash flow prospect, because accrual basis is good, but we don't want to get so wrapped up in there and then the company can't pay its bills and stay in operation. So companies also, with their last statement, the statement of cash flows, indicates whether it can pay its bills as they become due. Next, we have the chart of accounts, and we talked about this. To reflect what's going on in the company, there are assets, there are liabilities, there's stockholders' equity, revenues, and expenses. So we utilize accounts in all these areas to reflect the individual things that the company has. So for assets, we have an account for each asset: cash, receivables, inventory, supplies, and these are the current assets. Then for the liabilities, land, auto. So a business lays out all of its assets, and it keeps track of its assets with an account for each one. Liabilities, the same thing. Every liability is kept track of in an account: accounts payable, salaries payable, earned revenue. And then you have the non-current liabilities: notes payable, notes payable. Then we have stockholders' equity, which consists of common stock and additional paid-in capital. A lot of times, the stated value of the stock is, say, $50, but if that price goes up, it costs a lot of money to change the par value of the stock, and so we just receive more money for it, and we make an entry debiting cash, crediting common stock. For what we get more than the par, we put that on additional paid-in capital. When companies buy back their stock, they debit treasury stock and credit cash. So a lot of times companies do this so that they can have fewer shares outstanding and their earnings per share of stock looks better. So it's a good thing to do from the company standpoint, not necessarily from the employee standpoint. Retained earnings represents the cumulative earnings in the company reduced by dividends. Dividends are distribution of company profits to shareholders. And then we have the income summary account, which is a temporary account. Now, every account from retained earnings up goes on the balance sheet. The dividends and income summary accounts are closed out. So they're not on the income statement and they're not on the balance sheet. They have zero balances when the closing period is done. Then we have the revenues, sales, and if we have returns and allowances or discount, we want to report them separately because we need to know, have control over this. Abuse can occur. So we want to know what are the sales returns and allowances and what are the sales discounts. Then there's rent revenue. Sometimes a company loans, rents out space to subtenants, and they make money from that. Then we have the costs and expenses, cost of goods sold, sales, salary, advertising, all the expenses, and we lay these things out. So looking at this chapter and these items, these are terms, we've gone through them. You can now go back and look at these terms, see where these assets are. So this is a good reference spot for you to know all of the types of accounts that we work with. You should not create any additional accounts. Try to fit everything you're doing into this chart of accounts that we have. For companies, we also have a gross profit and net income, the earnings per share, and this is where I was talking about companies buying back their stock. The higher the earnings per share, the higher the stock price and value of the stock. So if a company wants the share value to be higher, they buy the stock back. Then we have the current ratio, which is a liquidity ratio, which is very important, which measures a company's ability to pay its debts. And so the current assets got to exceed the current liabilities. And a lot of times we want a ratio of 2 to 1 or 3 to 1 to make sure, because remember, you can only pay your debts with cash. And so in the current asset category, we have materials, insurance, receivables, and all those items, but only the cash account can be utilized to pay expenses, to pay wages. And so you need a lot of current assets. And they have to exceed your current liabilities when you're running a business. The financial statements, once again, the income statement is for a period of time, for a full year. Revenue less expenses give us the gross profit. Less the cost of goods sold give us the gross profit. Less the operating expenses gives us the net income before tax, and we have to pay tax, the net income per tax. And then you see these stipulations of earnings per share, operating cash flow, dividends for the year per share, and it shows how the earnings per share calculation is done. It's the net income divided by the outstanding shares. So that's why we said to make this number look better. If you buy back shares, it looks better. Statement of retained earnings, a simple statement which shows the amount of the earnings that have been retained in the business. Beginning retained earnings plus the net income less the dividends gives us our ending retained earnings. Then we have the balance sheet, and we typically going to do this for a 2-year period, the beginning of the year and the end of the year, so we can compare what's happening. Current assets at the top, fixed assets, total assets. The balance sheet represents the accounting equation, and so the liabilities and the stockholders' equity always have to be equal to the total assets if we've done everything correct. So total assets, total liabilities and equity. And finally, we have the statement of cash flow. And we have cash flows from operating activities, cash flows from investing activities, cash flows from financing activities, and the change in cash. Cash flows from operation is like salary. We want a business to have its cash coming from the assets that it sells. We want this number to be positive. Cash flow from investing, we want this to be negative because this is where the company invests back in the company. So we want it to be able to expand. So it's good if this number is negative. And then the cash flows from financing is good if we're paying off our debts and paying dividends. So we don't mind this number negative, but then the change in cash needs to be positive. So in a good company, the cash flow from operations, there's a positive net change. the cash flow from investing is negative, and the cash flow from financing is negative. And yet we end up with a positive cash flow. So this is the review. This is the theoretical framework for everything we do in accounting.